Hey, it's Wayne from truthaboutmortgagerates.com and WFP Mortgage here with the Heloc surprise number 2. In our first video, we talked about how a lot of Helocs are being either cut or eliminated altogether so people can't access the equity that they have. Now, in the second segment here, we're going to talk about if you do have that line of credit and you have a balance, how do you want to manage the risk associated with that line of credit? Now, most lines of credit are set against prime. Now they may be at prime, below prime, or a little bit above prime. That's called your margin. Now many new lines of credit also allow you to fix a portion or the balance that you currently have and then still have the remainder as available credit. Now if you have that fixed, then part of what we're talking about here may not apply, but it does in some ways, and I'll get into that. What we're talking about more specifically is if you have any amount of that is going to be outstanding on a line of credit that is going to be tied to prime. So as we look at interest rates moving up here in the near future, now we've already seen long-term rates move higher. That's why 30-year fixed rates are anywhere from a half to a full point higher than where they are at the lowest point this year. And a big part of that is inflation. Now, more information about what moves rates and what's happening in the marketplace because of that, check out our report at truthaboutmortgagerates.com. Now, what we're looking at here is, again, assessing the risk of with rates moving up and what you have for your overall financing on your home. If you have a small amount on a second mortgage in your line of credit as compared to how much you owe in your first, then really all of this applies so much less. If you only owe $10,000 or $20,000 and you have a $200,000 or $300,000 first mortgage, the difference in your overall payment percentage-wise, even as rates go up, really is not that much. So typically people can absorb that. Now, some people say, here, I don't want to have my payments going up much at all, and that's where you may want to look at this information a little more closely. Now, obviously, if you have a small line of credit, but your first mortgage is also small, depending on where you live and if your property values are lower, then again, as a percentage of your payment, the difference can be larger. But we're going to be looking at, for most likely, rates moving higher over the next couple of years, either with inflation, if it remains a persistent issue. The Fed is going to need to hike short-term rates, which prime is tied to Fed funds rate, and then prime goes up. Therefore, now the rate on your home equity line of credit is going to go up. So as we look at that coming forward, now even if inflation does not stay higher, say that comes down. But if that comes down, then it's probably going to help the economy to turn around. When the economy turns around, it starts to expand. That then brings on inflationary pressures in and of itself. So that is going to have the Fed come up to look to hike interest rates to help to slow growth. Now it may, again, take some time for all of that to play out. But what you want to do is you really have a bit of pre-planning when you're looking at these things. Because the issue that most people end up looking at is they wait for rates to go higher. At that point, then they go, oh, I should lock this in. And they say, gee, can I combine my first and second mortgage? Well, at that point, if inflation has been up, which is typically the reason why the Fed has hiked short-term rates, that has also moved long-term rates higher. So that what they can get at that point in time is much higher than what they get typically, say now, when rates have been lower and inflation has maybe not as much of an issue. So as we look at now, we would expect if either inflation continues to be an issue or the economy starts to pick up again, and again that drives long-term rates up because of concern about overall inflation, you're not going to be able to get rates that are available now. So if you're looking at that as an overall risk situation, obviously the bigger or the larger balance that you owe on that second mortgage, the greater difference it's going to have. But most people looking at things now say, here, rates are down, it's great, and they may have rates in the 5s, some people even have rates in the 4s on their second mortgage, and everything seems fine. But as history has always shown us, if you go out and rates move up higher, last time the Fed hiked rates, you saw over 300 basis point move, meaning 3%. If you're at 5 today, and if it follows the same path, you'd be looking at paying 8% or more on that line of credit. You're looking at, that's almost a double to what you're currently paying. So you want to be able to anticipate what's going on in the future to say, gee, should I take some action now? Now, you may be able to lock your line of credit if the current lender that holds that allows you to lock a portion of that balance, or you can be able to look to combine what you owe on your first and second mortgage. And that brings us into the situation of blended rate. Now, if you have some people say, well, I have a very low rate on your first mortgage, I don't want to touch that. And some people still think, well, my first mortgage is my mortgage, and then the line of credit, really, that's my line of credit, and kind of it's not have anything to do with each other. Well, it's your total overall that you owe, and really they do play into with each other, because it's your overall blended rate is what you're paying. If you have something that's the same balance, say for $100,000 each, to make numbers simple, if you're paying 5 and then you're paying 6, well, in the middle is 5.5. Obviously, if the balances are different, it will change. But you are paying that overall money. You owe the overall amount of money, and that blended rate then factors in. And the higher that second mortgage starts to go, the rate on it, then it starts to bring your blended rate up. So what you should be looking at is, if you were to see a 2 to 3% increase in your second mortgage interest rate, would that cause you to look to refinance and combine the two of them? And if it would, then you may want to look at refinancing both of those currently now. Now, depending on, again, with guidelines and things that are out there, you may or may not be able to, and depending on values, obviously in today's market, are playing a much bigger role. But if you do have the equity, you may want to talk to a mortgage professional. Again, when I say professional, a mortgage professional, to have you understand how does it factor into your particular plan. Because you don't want to be left when rates are rising and then realize, oh, I should have done this a year ago or 2 years ago, to be able to, again, cut down your risk and take advantage of the rates that we have available now. Check out truthaboutmortgagerates.com, again, with all the explanation about really what goes into rates, what's making it move, and the things that you need to be aware of. And also, another announcement, we have our new site that's going to be coming live soon. It is available for you to put in notification to get notified when it actually is live. It's askyourmortgagemeltdownquestion.com, or for short, AYMMQ, Ask Your Mortgage Meltdown Question, where you're going to be able to ask your question about anything related to the mortgage industry and the mortgage world, about how it may affect you, what's going on with adjustable interest rates, home equity lines of credit. Should I refinance? Is this maybe a good time to buy? What about investment property? Any number of questions on how you want to approach things, and we'll do our best to answer those questions. But you can go there now, and you can put your name in to be notified when that site goes live. It will be live very shortly, where you'll be able to ask those questions. Maybe you've had things and you're not sure who to ask. Now's the time you can do that. So you can click the link, truthaboutmortgagerates.com, also AYMMQ. Click the links over here, and also, if you like our videos, subscribe to our videos so you'll be notified when we have a new video that comes online. Until next time, this is Wayne from truthaboutmortgagerates.com.